Hi there traders, this is Steve Miley, the market chartist for FX Explained, and here we're going to take a look at the FX markets, the Forex markets, and we're going to take a look at the risk currencies. So that will include the Australian dollar versus the US dollar that we have here. Also going to take a look at the New Zealand dollar, the Kiwi dollar versus the US dollar, and the Canadian dollar versus the US dollar, the Canadian dollar known as the loonie. So we're going to be looking at the Aussie, the Kiwi and Canadian dollars all against the US dollar in here. And we've seen a real kind of different dynamic going on over the past week, certainly over the second half of this week, but pretty much through the week in here, where we've had more of a shift to more of a risk off scenario with stocks, particularly European stocks, to a lesser extent Asian stocks. If we're going to take a look at, say, the DAX in here, we're going to just jump to the equity markets, but you look at the DAX in here, very negative. It's been selling off from mid-October, sold off throughout this week, aggressive sell-off yesterday. Yes, we did have a rebound, but very much negative in here on the stock side. Even the S&P 500, if we go to that in here, not as negative, but still look lower from mid-October, grinding lower this week. Again, a little rebound in here overnight, but still a more negative theme overall. So that's a risk off scenario, risk off, traders, investors willing to take less risk, okay, less risk appetite, risk off scenario. However, and normally in that scenario, the risk currencies, which we would include the Australian dollar in, the New Zealand dollar, the Canadian dollar, these risk currencies amongst the majors, usually they do badly. But what we're seeing in here is the correlation has shifted between equity markets and the US dollar. Generally speaking, particularly in this pandemic global world we're in, that we've seen in the financial markets, we've seen risk off, traders, investors to willing to take less risk, equity markets down, and we've been seeing a more positive US dollar, the US dollar acting as a safe haven. But in this scenario over the last week, we've seen the US dollar actually weakening against most currencies in here, whilst also seeing equities looking more vulnerable. So equities down, but more vulnerable, not aggressively down, but certainly European equities looking very vulnerable. The UK 100, the FTSE 100 looks super vulnerable. We can just jump quickly and take a look at that. You know, FTSE 100 in here looking very negative, been grinding down since June and sold off in here from mid-month, selling off this week. So equities looking at globally, particularly in Europe, very, very negative. But in that same scenario, we're seeing US dollar weakness, and that means we're seeing the Aussie, the Kiwi, the CAD going up, rallying against the US dollar. So the correlation has certainly shifted around. But let's take a look at some of the charts. So we've seen this Aussie rebound in here. Now, bigger picture, I would still be negative. We've got this whole sell-off. The market's been moving lower, lower lows and lower highs in here. It's more in a range environment, really, between 72.44 and 70.02 at the moment, okay, on an intermediate term outlook. But in the very short term, you'd have to say the market looks relatively positive, and it's been up challenging this 71.37, 71.48 resistance area overnight in here, and does look more positive in here in the very short term, although the bigger picture is probably more negative, although that is within this kind of range environment, 70.02, 72.44. If we look at the Kiwi dollar in here, though, so I'm just going to zoom in on that, on the Kiwi dollar, it's been tracing out this potential topping pattern, a potential double-headed head, shoulders, double-headed head and shoulders. So here's the head, here's the other head, two heads, and here, which create this double top pattern here when we broke 65.99. But then you've got this bigger shoulder over here. All of this is a bigger shoulder. So you can have a look at that there. You've got two heads, and then you've got this other shoulder has developed. Now, we were close to breaking down and signaling a more negative tone in here with this only early this week. We were looking to break down through this maybe neckline for the head and shoulders. You've got supports here at 65.43, 65.08, and critical at 64.86. Again, kind of in a range theme in here. I'm defining the range by 66.82, 66.88 on the top side, and 64.86. So only beginning this week, it has looked like we were going to have this double-headed head and shoulder. So let me just put that in, actually, the double-headed head and shoulder. So in here, if I take a look at this, just move this to one side. So you've got this big kind of shoulder over here. You would define this as the shoulder of the head and shoulders. So you have the shoulder over here, and then you'd have this double head here. So you've got the double head here. So head. Oh, it's not doing so well in here, am I, with that? Let's have another go at that. So in here, you've got this kind of head here, and you've got the other head here. And then you've got this kind of broader shoulder over here. So you've got this bigger shoulder effect over here. Okay, so you've got this kind of double-headed, two heads up here. And then you've got the two shoulders over here. Okay. but the market rejected that, and we're all the way back up, and actually then overnight in here, overnight we've gone right up into my resistance zone here, 66.82 and 66.88, important little impulse failure peaks in here, and the market's gone right up to the top of that in here, up to 66.88 overnight, and just fading there. If we can get up to and through 66.88, this actually shifts the intermediate term outlook to more negative, because then you've rejected this head and shoulders top that I've been talking about. And if you can reject a potential bearish signal, look how close we got at 65.49 to breaking the neckline in here. We were literally 10 to 15 pips away from signaling a more bearish shift, and now all of a sudden you've got a more potential for a more bullish shift if you take out these peaks, because then you're completely neutralizing this shoulder over here. So that's the threat on the upside in here for Kiwi dollar. And if we look at the Canadian dollar's stayed more bullish throughout really in here. So if we take a look at the Canadian dollar, we've had this whole US dollar weakness, Canadian dollar strength coming from March. We haven't really properly tested that in here, because the market did rebound in here and fouled at this resistance at 134.20, back from 134.18.19. That's kept the bigger picture, the intermediate term bearish pressures intact. And then from late September, early October, we've had this sell-off. We only had a marginal rebound in here in the middle of October, and then again the market's selling off again. We were down to 130.77, a new setback low in here for October, only at the beginning of this week. We've had a slight rebound, but again the market's fading back lower from below this small little trend line that comes down from September. It's faded back lower from 131.78, and all the threat for me is here back to the downside, and potentially to challenge this cycle low here at 129.90 going into next week. So again in here, US dollar weakness, Canadian dollar strength, and that is sitting counter to what we've been looking at and seeing all throughout this whole pandemic. And then the general, not just through the pandemic, the general correlation is, risk currencies up and stocks up. So in here at the moment, what we're seeing is the risk currencies are trying to rally. We just looked here at Canadian dollar, we looked at Aussie, we looked at Kiwi. They're all trying to rally, go up against the US dollar, and we're seeing that in tandem with weakness that we're seeing across global equity markets, particularly those European equity markets. Okay, so they have to watch out for that dislocation. That correlation may come back, okay, but however at the moment the markets are not correlated as they have been traditionally in the long term, and certainly throughout this whole pandemic. Okay guys, I'm going to leave it there and wrap it up. I'm going to wish you all a great trading day. Please do stay safe out there. I'll have another report back with you next week, and until then, yeah, have a great trading day. Take care. Bye.